Welcome and thank you, everyone, for listening in on our latest Economic Outlook report with an exciting topic focusing on opening the US economy and the latest in employment trends. Leading today's economic update is Prevedere's Chief Economist Andrew Duguay. Andrew, we're looking forward to your latest insights. Thank you for joining us.
Thank you, Nicole, and good to be back. Today we want to talk about jobs, and there was a rather large and important jobs report that came out last week, and it was a surprise in a positive direction. The fact that the Bureau of Labor Statistics says that there was 2.5 million jobs created in May. Of course, this is a rebound from a very dismal April and all the shutdowns due to COVID-19. So it was good to see some positive numbers, and the stock market reacted positively. I think the surface headlines might cover up some facts that we need to address when looking at statistical data. Now, we've talked in previous economic updates that we do expect the US to have a very sudden downturn followed by recovery, much in line with the shutdowns, right? The health crisis has necessitated an economic crisis, and yes, jobs will recover. We've given some statistics before about how many jobs we think will recover, including citing some economists who said around 40% or so of jobs may be lost permanently due to this. Well, that still means 60% of jobs get recovered, right? And over 80% of those filing for unemployment or somewhere close to there were filing under temporary status. And so as in May, it really shouldn't come to any surprise that we're seeing some leveling off of the job losses, because a lot of these were due to mandatory shutdowns, and as states moved to reopen in May, many of those temporary jobs would be gained back. So why was this such exciting news? Well, part of it was because economists as a whole, when surveyed, were suggesting that the May jobs report would result in about 8 million jobs lost. And when the Bureau of Labor Statistics number came out at 2.5 million jobs gained, it was a rather large surprise, surprise to the positive side. So let's dig a little deeper. So why were economists so pessimistic on this? Well, for one, data has been largely more unreliable since COVID-19, right? We have all been talking about the need for additional sources, high frequency sources, and just the nature of this very rapid downturn has caused some rather statistical uncertainty that has created wider deviations between statistical sources than normal. When those who pay close attention to the unemployment rate know that a few days before the Bureau of Labor Statistics releases their unemployment rate numbers, there is another payroll report that comes out from ADP, the private payroll processing company. It's called Total Non-Firm Private Payroll Employment, and the year-over-year growth in this figure is shown in green on this chart. Now, this becomes a very important report because when it comes out, it tends to be a very good precursor to what the Bureau of Labor Statistics is going to release and say a couple days later. And the ADP report suggested about 2 million job losses in May. And so this was a very big surprise when in May, the Bureau of Labor Statistics numbers showed that May was a positive number. Now, a closer look at this, and I'm showing you this chart showing you these two very releases, the Bureau of Labor Statistics private employment level versus this ADP number from the payroll processing guys, and showing them both on a year-over-year basis, just so you can see that before the crisis, these two numbers did align very closely, very tight. They weren't exact numbers, but very tight on a year-over-year basis. And then you can see if you look down towards May that the blue line, the Bureau of Labor Statistics number, was much more positive than the green line. However, I think we should put this in context that this has actually been par for the course since the coronavirus started. These gaps between what ADP has been saying and the Bureau of Labor Statistics have been saying have been generally wide. And if you measure it on a difference between the year-over-year change between the two, that there's really not that much of a difference. Sure, May was a 2.5 percentage point gap between the two, but notice the month before the ADP number was more positive and the Bureau of Labor Statistics one was more negative, and very similar in March, where there was a 2.25 percentage point gap between the two. I think all this is to say that there could be revisions to this number, and there's a lot of uncertainty in this Bureau of Labor Statistics number. So when people jump to the conclusion that the recession is over, that jobs are recovering so much faster than really anybody was expecting, I would say, hold on, let's look at some broader measures of the overall economic performance, and also realize that we need to separate out what were the jobs that were just naturally going to come back once businesses started to open versus the real crux of the labor issue is that, are we going to regain 80–90% of the jobs that were lost, or is it going to be something much smaller? And that will create much bigger problems for the US economy going forward. So it's good to see, obviously, positive numbers from the Bureau of Labor Statistics. However, keep in mind that these things oscillate, and that even normally very high statistical correlations between surveys are showing much different numbers, and it's not just the May number, right? This happened in April, this happened in March. Another couple things to note from the unemployment rate is that the number went down in May, which was positive to see unemployment rates falling. Of course, that's from April when virtually everything was shut down. That was forced to. So the total number came to 13.3% unemployment rate. However, there's a few caveats to this. One is that the Bureau of Labor Statistics says that the unemployment rate could possibly be 3 percentage points higher from the official number due to some misclassification errors that they are dealing with. These misclassification numbers have to do with some ways that people are filing about being employed but absent versus temporarily unemployed, which would make the unemployment rate higher. If you accommodate for these misclassification errors, you could see an unemployment rate, this is from rates from the Bureau of Labor Statistics themselves, of up to 16.6%. I put that in the red circle there, and just to show you that if what we could be looking at, just basically from different measures and errors in the survey, is an unemployment rate that's much higher. I think historic context is important, because if whether we're at 16.6 or 13.3, you look back and you should say that even with the May numbers, even with that 2.5 million in jobs gained in May, we are still at an unemployment rate that is higher than in any time since the Great Recession back from 2008, 2009. And we know that was a very tough economic time for a lot of people. So a little bit of context there. I think also adding to the context of this uncertainty, is it 13.3, is it 16.6, is the fact that even the good folks at the Bureau of Labor Statistics have mentioned that it's getting harder to survey. So these statistics come from a household survey that the Bureau of Labor Statistics does every month and has been doing for years. But they've noted that since coronavirus, the survey response rate has dropped significantly. Normally they have a survey response rate of around 82%, and that's actually fallen 15 percentage points down to 67%. Normal statistical approaches is to try to accommodate for this error, but naturally I think whenever you see a large change in survey response rates, you can assume there might be a wider margin of error, more likely that they might have to do revisions to the data further down the road. Now, some of this is just natural due to the times, and you think that household surveys that normally are a combination of phone calls and other approaches might result in less activity, just like we're seeing in a lot of social distancing aspects. But these kind of things need to be kept in mind. So there's a little bit of a peel back for our audience, hopefully today, into some of the uncertainty that we could introduce in statistics that we normally follow. So headlines read a positive number. I don't necessarily want to deflate from that, but as we've said before, this is going to be a long road to recovery. And while we do expect the job market to continue to improve, we should see more jobs being gained over the course of the next few months as more and more states open back up. However, we do need to say, let's take a wider context to the numbers and understand that there's still a wide margin of error. We still have a long way to go in the recovery, and any sort of positive surprise release like we've seen last week with the job numbers has to be taken into consideration with the wider context, and that this doesn't mean anything necessarily that we're all of a sudden in line for V-shaped recovery and everything's going to be okay. So let's take the positive numbers, but let's also take the broader context of the very challenging economic situation that we're in.
Wow, thank you, Andrew, for the nuanced presentation on jobs information coming out. Lovely to see some positive trends finally developing on the unemployment front, as well as your insights on data trends and how to interpret what we're seeing as well. So if you have any questions for Andrew, please feel free to contact us directly with the contact information on the screen. That concludes this economic update. Stay tuned for following presentations. Thank you.